The Forex landscape is bracing for potential turbulence as the repercussions of the Federal Reserve's recent actions and the upcoming end-of-month financial flows could lead to significant market shifts this summer. The Federal Reserve's influence, the speech delivered by Fed Chair Jerome Powell at the Jackson Hole Symposium, is expected to resonate for quite some time. Investors and analysts alike are keenly observing the implications of his remarks. Powell's address was met with enthusiastic applause from attendees, including fellow central bankers who rallied behind him. The markets responded positively, interpreting his message as a clear indication that interest rates are set to decrease, primarily due to concerns surrounding the labor market's fragility. While the decline of the US dollar and the surge in gold prices seem logical, one must question whether the rise in stock prices is warranted. After all, reducing borrowing costs in response to economic downturns is not necessarily a cause for celebration. Adding to the drama, former President Donald Trump has intensified his scrutiny of Lisa Cook, a Fed governor appointed by his predecessor. Trump has threatened to dismiss Cook over allegations of mortgage fraud, which could lead to a contentious legal battle. If he succeeds, it would allow him to install more of his allies within the central bank, raising serious concerns about the Fed's independence. With a rate cut in September appearing inevitable, speculation is rife regarding the magnitude of this cut. Will it be a modest 25 basis points, or could we see a more aggressive reduction? The former president is advocating for a more substantial decrease. U.S. GDP data on the horizon. On Thursday at 12:30 GMT, the initial reading of the Gross Domestic Product, GDP, for the second quarter will be released. This report is particularly significant as it indicated a 3% annualized growth rate, surpassing expectations of 2.4%. This rebound follows a contraction of 0.5% in the first quarter, making the updated figures all the more critical. Investors will be closely monitoring not just the headline growth number, but also the details regarding consumer spending, which is the driving force behind the U.S. economy. Any notable shifts in this area could send shockwaves through the markets. Jobless claims raise concerns. Also on Thursday at 12:30 GMT, the U.S. will publish its weekly initial jobless claims and continuing claims data. Both metrics saw an uptick last week after a period of relative stability. While initial claims remain low at 235,000, the rise in continuing claims, indicating individuals who have been out of work for an extended period, is particularly alarming. If continuing claims approach the 2 million mark, it could weigh heavily on market sentiment. Conversely, a stable or declining figure would offer some reassurance to investors. As is often the case with simultaneous data releases, a coherent narrative between GDP growth and jobless claims will be essential for a significant market reaction. Core PCE inflation insights. On Friday at 12:30 GMT, the Core Personal Consumption Expenditures (PCE) Price Index, the Fed's favored inflation measure, will be released. This data follows the Consumer Price Index (CPI) report, allowing economists to analyze the PCE results with greater accuracy. The core PCE has surprised analysts by showing a year-over-year increase of 2.8% in both May and June, indicating that underlying inflation pressures remain high. Will this trend continue? If so, it could dampen the market's enthusiasm for an interest rate cut from the central bank. The monthly figure for June rose by 0.3%, and the July report is expected to mirror this, suggesting an annualized increase of 3.6%. Which is uncomfortably elevated. End-of-month market dynamics. Friday, particularly at 1500 GMT, will see money managers adjusting their portfolio allocations as the month comes to a close. This adjustment often leads to heightened market volatility, especially with the upcoming long weekend in the U.S. due to Labor Day on Monday. August typically brings lower liquidity levels, meaning that even minor trades can lead to significant market fluctuations. Final thoughts. As we navigate these pivotal moments in the market, the combination of critical economic indicators and reduced liquidity could lead to unexpected market movements. It's essential to approach trading with caution during this period. Disclaimer: the information provided here contains forward-looking statements that involve inherent risks and uncertainties. The markets and instruments discussed are for informational purposes only and should not be interpreted as a recommendation to buy or sell any assets. Conduct thorough research before making any investment decisions. FX Street does not guarantee the accuracy or timeliness of this information. And investing in open markets carries significant risks, including the potential loss of your entire investment. The views expressed in this article are those of the author and do not necessarily reflect the official stance of FX Street or its advertisers. The author has no financial interest in any stocks mentioned and has not received compensation for this article, aside from that from FX Street. FX Street and the author do not provide personalized investment advice, and nothing in this article should be construed as such.